Hello everyone, welcome back to my channel. So today is Saturday, August the 15th, and I want to take a moment to talk about a news piece that I received as a notification on my phone this week, in which apparently the government, the US government debt is already approaching $40 trillion in debt, in the national debt, comparing with a US economy which is around 30 trillion. So this gives you a debt of which is already close to 130% of GDP. And now, because of that and the interest payments that come with it, apparently the US government has been spending already 3 billion a day just to service the debt. So these are interest payments that they need to do, that the US government needs to do on this massive amount of debt. And it was funny because it came to me. I like a lot the US economic history, and it came to me the fact that back in 1992, in the run-up to the US presidential election, that one of the candidates, the U.S. businessman Ross Perot, wrote an article at the time and came even on national television, already ringing some alarm bells, which are, I found this article over here, and in which it was already sounding all the alarm bells on the fact that at the time the U.S., the United States, and keep in mind this was already on in late 1992, so almost 34 years ago. He was already warning that the United States, could not keep a $4 trillion debt, national debt, and a 330 billion federal budget deficit. Keep in mind, at the time, the U.S. economy was around 6.5 trillion in GDP. So a 4 trillion debt would be at around 60 to 65% debt to GDP. So now we are about double, because we are by around 125, something like that. The last data that we have in here from December 2025, this is 123%, but I think it's already gone up a little. And already, in comparison with this 330 billion federal budget deficit, we are already way beyond that. At the end of 2025, we have already the US already had a deficit of almost 1.8 trillion. So to keep numbers in perspective, if you think that if you think about a US economy which at the time in 1992 was around 6.5 trillions of dollars, we can safely assume that roughly the US economy grew over these 34 years by around fivefold, but the debt went from 4 trillion to 40 trillion almost. So it grew up tenfold, and the federal deficit grew by a little bit less than a factor of sixfold. So, and currently at this point, with 3 billion a day, we are reaching a situation in which we are almost paying, or the US government again are paying almost $1 trillion just to service the debt, just in interest payments. So this should be a very significant warning sign for the US society to do something about this, and especially to do something different, because this is not a problem. This is not only a problem of the current administration. This has been going on since the Clinton administration, when the last, which was the last administration who managed to post the budget surpluses. The first year of the George W. Bush administration still posted a surplus, but it was already a much smaller one, and from that point onwards, there were only budget deficits on top of budget deficits, and yeah, this is really a situation that should make people think about where this country is headed. But coming back to business, and to what we have been doing over the course of this week. Now, as things stand at the moment, and predictably so, we managed to get rid of our 1,000 shares in SILJ. We broke even on the shares, and we managed to sell those shares by $26 a piece, as you can see right here. So we collected $26,000 here, and to keep things into perspective, as you can see over here, we had 100 shares that we bought at $33, so we lost $700 on those, and those are around here in May, if I believe this is correct. Yeah, they were here. So we managed to with the premiums, we just lost $392 on this particular 100 shares, right? We also posted a loss of, let me just see what it is. Yeah, here. There were 200 shares that we bought at 29, and now we sold at 26. So $600 in a loss, which is right here. So there is another one. It's better to do it this way, like this. And there they are. So with this $600 loss, we managed to recover somewhat with the premiums, and we had the loss of only $314.52. All right, but then with the other shares, 700 shares that we also bought on the lot of 200 that we bought at $24.50, we managed to get a $300 gain, and on the 500 shares that we bought at 24, is sold at 26, we managed to get $1,000 in gains. So with a loss of 1,300 and a gain of 1,300, we broke even, and they are right here. This lot of 200 shares at 24, another lot of 200 shares at 24, the 200 shares that we bought at 24.50, and the remaining 100 shares that we bought at 24. And this was the gain, including the premiums that we collected. And this must be offset, of course, with the losses that we collected in here. All right, and now you can see here that we managed to get, with the premiums, we broke even on the shares, but we got a profit from the premiums of $1,233.78. So all in all, it's good. We still managed to collect the premiums. It's a shame that we just broke even, because the price went into the 28, 29s and 30s until the calls expired. So we left quite some money on the table, but yeah, that's just the way it is. And now we are contending just with the IAU and the SLV, so both the trust ETFs, which invest directly in gold and in silver. And there was no progress this week. We did not manage to buy any additional shares. We just managed to roll those over the course of the week, and then these puts on IAU just expired. quite funny and quite telling about the lack of liquidity of this ETF, of the options of this ETF. And this is one more reason why I don't intend to sell options on this ETF ever again. Funny was the fact that these 79 puts expired, and I let them expire simply because even yesterday, at the end of the session, there were no takers. It was not possible to sell, to buy back these puts at the price of 1 cent, even though the price was hovering around 82, and it was not possible to buy back the puts at 79 so that we could roll over these puts for the next week. And this is something that I've always been able to do in all of the other ETFs. In the SLV, this happened seamlessly so, but in the IAU, this was simply not possible. And this tells a lot about the lack of depth in the option chain of this ETF, and how difficult it is to, in case of a large price distance between our strike price and the current share price, how difficult it is sometimes to sell options. And so this is an experience that I won't be repeating again. With the SLV, we just managed to sell first some puts on the 54 and a half and 53, but then as the price kept well above that, we rolled over some puts to 57, but then because also those were already worthless, we rolled over those positions for next week. And with this setup over here, we also have another three contracts on with this strike price on our Emirati account. But the way we left things for the next week, and if these 13 contracts on 55 are assigned, we will be able to lower our cost basis to less than $66 a share on the SLV. And if the 600 shares that or the six put contracts that we sold on 54 and a half are exercised, we will manage to bring our costs to exactly $64.99, so just below 65. This number is not relevant here, but yeah, this is where we are. And by the way, we also have a few five put contracts on our Emirati account at 80 on the IAU, and we also have these 5 contracts for next week at 79.5. And if all of these are exercised, so assuming first that the 5 contracts on our Emirati account at 80 are exercised, we will bring our cost basis down to 82.62. And if these 5 contracts, 79.5, are exercised, we will bring our cost base to 81.75. And as you can see, we are within striking distance of the 82.62, and we are already above this $81 mark. So if we have a bad week ahead of us, which I don't think it's going to happen, but if something goes wrong or goes badly in the markets and the prices plummet, chances are we will be able then to recover, to sell our position in the IAU when the prices recover to around this level. When it comes to the economic data for this week, there was a lot of data to unpack, but the main highlights were inflation. And here, again, just like it happened yesterday, on the previous week, prices started to go up, of metals started to go up in anticipation to the inflation report. And those beliefs or those expectations ended up being relatively fulfilled, because here, as you can see, the CPI came exactly as it was expected. And so this apparent consistency between the expectations and the actual data led to the market continuing to rise. There was some pullback on metals on Thursday, even though the PPI data, as you can see here, came softer than expected. Month over month, there was no increase in prices instead of the 0.2 increase that was expected. And if you look here at the core PPI month over month, it went below the expectations. Expectations was 0.3, it came at 0.2. And year over year, this is the headline, you see that relative to the previous month, it came quite a long way below. So this was obviously a positive development. And in conjunction with the fact that finally we broke again over the 200,000 jobless claims, this would be all together, this would be signs that the Fed did the right thing in not increasing interest rates, or what the expectation that the Fed has in not increasing interest rates is being supported by the data. And then on Friday, yesterday, metals went up again, and probably one of the reasons for that was the fact that retail sales came down unexpectedly. There was the expectation of a growth of 0.1%, but instead came down 0.6%, which is quite a significant difference between the expectations and the actual value. And the consumer sentiment took a big blow, because it was supposed to be, or it was expected to be more or less the same as in the previous month. But for August, it was still in positive territory, but it took some dive. And these are all the data that came over the course of this week is data that supports the decision of not increasing interest rates by the Fed. And as a result of all this, the market, the bets on the Fed funds rate for the September meeting, the probability of an interest rate increase came further down. I think the last time I saw it was around 40%, and it was I think 50-50 before this previous week began. So things are moving in the right direction for metals based on the data. Next week, it's going to be, I believe, a pretty dry week. There is nothing remarkable here, no market moving data, except for probably on Friday when it comes to PMI for the manufacturing services. But still, expansions are expected. But this is where we stand at the moment. Next week, besides these puts that we already sold, we still have, as a result of the 79 puts on the IAU expiring worthless and the $26,000 that we receive as proceeds from the sale of the SILJ, we have 44,000 euros still to deploy on puts. Again, now it's just focus on IAU and SLV to see how can we get rid of these. And let's now proceed to our Emirati account to see what went on over there. And here we are in our Emirati account. Again, like I mentioned previously, there was no progress whatsoever. We just basically rolled over trades from one strike price to another. There was nothing here that we could do. The strike prices that we selected were never really threatened by how the market developed. And now we have already posted our trades for next week. We have the 3 contracts that we mentioned on the SLV, all right, the ones that make up for these 6 contracts on 54.5 strike price. And we also have the $580 contracts here for the IAU. And here you see that we are already out of buying power. We have only $1,800 left, and so there's nothing we can do for next week. We have just wait and see what's going to happen. so that then we can maybe roll up these prices, these puts into puts with a higher strike price, because we still have the buying power to roll them up. And so yeah, we'll see what's going to happen. For the time being, this is pretty much it. Feel free to leave your comments in the comment section down below. I am also available on LinkedIn in case you need to ask me any questions. And as always, feel free to like the video and subscribe to the channel. And we'll reconvene on Monday to see how the week started. And I'll see you there.